Welcome back to Beyond the Benchmark. I'm Ryan Kasper. As we head deeper into the holiday season and toward the final stretch of the year, the data flow has finally begun to normalize after the government shutdown, though much of it still comes with a few asterisks. Last week's numbers gave us a clearer, if imperfect, snapshot of an economy that's slowing modestly, but still holding together. Inflation readings improved, with CPI rising just 0.2% on both a headline and core basis. Year over year, headline inflation has eased to about 2.7%, while core sits near 2.6%. Those figures were complicated by missing data and unusual reporting periods, but markets welcome the signal that inflation isn't re-accelerating. And that matters as we look toward potential rate cuts in 2026. Retail sales were flat on the surface, but once you strip out autos and gasoline, spending was stronger than expected. Core retail sales rose 0.8%, driven by furniture, sporting goods, and online sales. And over the past year, consumer spending is still growing faster than inflation. Manufacturing and services data softened a bit. Both PMI readings pulled back in December, with survey respondents pointing to slowing momentum, rising costs, often blamed on tariffs, and a bit less confidence about the months ahead. That said, employment components remained in expansion territory, suggesting firms are cautious, but not yet pulling back aggressively. The Empire Manufacturing Survey was especially volatile, reminding us how noisy regional data can be late in the cycle. Housing continues to cool gradually. Existing home sales rose slightly in November, helped by lower mortgage rates around 6.3%, but year-over-year sales are still down. Prices remain relatively flat, inventory is tightening again, and builders are increasingly offering incentives as affordability remains a challenge. Housing wealth is high, and homeowners simply aren't in a rush to sell, especially heading into winter. Labor data was mixed, but steady. Payroll growth came in slightly better than expected for November, though revisions offset some of that strength. The unemployment rate ticked up to about 4.6%, wages cooled, and underemployment increased. All signs of a labor market that's easing, but not cracking. Jobless claims remain contained despite seasonal noise around Thanksgiving. Markets reflected that mixed but manageable backdrop. U.S. equities finished the week mixed, with strength in technology and consumer discretionary offset by weakness in energy and real estate. International stocks outperformed, helped by central bank moves overseas, including a rate cut from the Bank of England and a historic rate hike from Japan. Bonds caught a bid as yields drifted lower, while commodities were mixed, with strength in metals but continued softness in energy prices. I'm Ryan Kasper. Thanks for tuning in to Beyond the Benchmark. Wishing you and your families a safe, restful holiday season, and we'll see you next week.